Welcome everybody to this new webinar organized by the Institute for European Policy Making at Bocconi University. My name is Stefano Feltri. I'm a journalist working with YEP. And today we are here to discuss a very important topic. I like the title of this webinar very much because it keeps everything together, the geopolitical strategic perspective of the global minimum tax, which means that we are discussing the global minimum tax not only from a taxation perspective, it's not just a fiscal issue, it's a geopolitical issue, it's a strategic issue, it's something relevant for transatlantic relations. And this webinar goes in the direction of other events we are organizing in this moment that try to create a bridge between the economic and law debate and the geopolitical current events that you all know. So geopolitical perspective is super relevant. And that is because I truly thank Carlo Garbarino, who is a professor at Bocconi and is a fellow at YEP. And he had the idea to organize this webinar, and he thought to this very insightful title, which will be the framework of our discussion. And our discussion will involve Ana Cinta González Cabral. I don't speak Spanish, so I hope that the pronunciation is not too bad. That she works at the OECD Center for Tax Policy and Administration, and the OECD is a key player in this debate. So we truly thank Ana for being with us. And we also have Roy Benavi-Yona, who teaches is a professor at University of Michigan Law School, and he will be the discussant, and he will offer us a different perspective, a more US-centered perspective, which is super interesting in this topic. So how things will work. Carlo Garbarino, he will offer us initial remarks on the global minimum tax. Then Anna will add her comments, and Roy Benavi-Yona will be the discussant. Just two clarifications. Please remember that we are on the record, so the event will be recorded and published on our website. And if you have comments, questions, remarks, you can use the chat, and my colleague Georgia and me will have a look at the chat. And at the end, we will have 15-20 minutes for Q&A. Also, if you want to stay updated with what we do as YEP, you can subscribe to the newsletter. You find the link that my colleague Georgia has just posted in the chat. So with no further ado, I give the floor to Carlo for his introductory remarks. Thank you all.
Thank you, Stefano. Thank you for Anna, and thank you to Anna, and thank you to Ruben for being here, and I thank all the participants. This is a great opportunity to, in a way, to fill the gap between the sheer technicalities and complexity of the so-called global minimum tax and its strategic dimension. And we really took the opportunity and thank Anna and his co-writers, because there are several authors to the paper, The Global Minimum Tax and the Taxation of Multinational Profits, because it's the first post Pillar 2 research that tries to quantify the impacts of Pillar 2. So the idea was to combine these findings that have, an economic basis with a discussion on the strategies that underline, the OECD work on that generated Pillar 1 and Pillar 2. This is a audience of super experts, so I will not go into the details in describing what is the BEPS project and then the ensuing Pillar 1 and Pillar 2 outputs, but I will just limit myself in saying that in spite of that, logically and chronologically, the OECD thought Pillar 1, the attribution of profits and revenues to the market jurisdiction, as the first step, and then Pillar 2 as a kind of corollary or backup mechanism should the market jurisdiction not act, we ended up with an opposite result, namely that Pillar 2 is a reality because, as you all know, in 21 the OECD enacted the very detailed model rules, and shortly thereafter the European Union, in a kind of symbiosis, replicated the same rules in a directive. So we have a very interesting situation in which what most of the people thought was a backup approach became the predominant approach. My position, the position of many or several other scholars, was that the main avenue to generate cooperation in this matter in addressing profit shifting and base erosion was rather than trying another time to find the perfect mechanism to allocate taxing profits. The main avenue was to for countries, for home countries, which are the country where most of the multinationals are, to enter into a kind of coalition to fight together. The race to the bottom of tax competition and aggressive and related tax strategies, by undertaking not only a technical but also a political obligation, a political responsibility of taxing their own quote-unquote multinationals on global profits. And as a matter of fact, what this is exactly, irrespectively from the sheer complexity, what Pillar 2 does, essentially attributing the power and the responsibility to tax a multinational as a global actor in the country of the ultimate parent entity. This is the actual denomination of the Pillar 2 rules. So why we can that why we decided to title to give that title to the strategic geopolitical perspective to our seminar, because I think that in addition to the technical aspects, we can now discuss run a discussion revolving around 3 or 4 topical concepts that come from global politics, geopolitics, international relations, rather than tax scholarship. The first one is, which I mentioned, is the idea of a unilateral dominant strategy. Sometimes to address a global problem, cooperation is generated through a unilateral strategy. These strategies are not necessarily egoistic strategies, but they have their feature is that they basically achieve the result irrespectively from the behavior of the counterparts. In this case, the counterparts are low tax jurisdictions. So the seminal idea of consolidating from a tax perspective the profits of multinational under essentially minimum tax, and this responds to the well-known principle of capital export neutrality, basically subjects all the profits to the same rate, thereby eliminating tax arbitrage. Then the other concept is the defensive coalition. So a claim that I made, and maybe we can discuss after we hear from Anna Sinta about their findings, is that basically what we have now on the table is a soft law, detailed soft law enacted by the OECD, non-binding, that at least for the EU geopolitical region has become a binding structure, because, as you know, the directive has now been implemented by 27 member states. So each member state in the global system of the of the global minimum tax, on the one hand, assumes the responsibility to tax multinationals. So the French will do that, the Italians, the Germans, so on and so forth. And at the same time, it will qualify as a qualified domestic minimum tax for other non-EU jurisdictions that implement the Pillar 2 outside the EU directive. So what we have here, we have a defensive coalition against profit shifting, against low tax jurisdictions that because of the common predominant unilateral strategy are faced basically with either, they can in a way keep their own low tax rates, but at the end of the day, the profits will be taxed at least a 15% minimum rate. And then the third concept that comes from international relations, which is important and quite resonates with the current situation, is that of an international regime. We generally use international regime term in a very broad and a technical way, but this concept has been clarified in international relations and global politics as rather than as a legal agreement, a social institution in which parties converge because of their interest into a focus point in which they share the interest. So basically, in spite of the fact that the OECD has claimed to have an inclusive framework and has claimed to have achieved an agreement, a legal agreement, there is no agreement here except for the fact that the European enacted a binding directive. But in spite of the lack of formal binding rules, the expectation and the trend greatly enhanced by the step taken by the European Union is in the direction of several major jurisdictions coming into this defensive coalition based on a unilateral dominant strategy, and thereby creating an international regime, so that, as it occurred in many other areas of international relations, rather than starting with a very difficult to be negotiated and very difficult to be signed by many parties, multilateral formal agreement, we start with a regime, and then maybe we can ratify that through formal rules further down the road. So, and this leads to a third seminal concept that comes from international relations into the global corporate tax arena, which is minilateralism. Starting from climate change and other major global problems, we have seen, and scholarship has that we don't really need full global multilateral cooperation to address certain problems. But what we essentially need in many occasions is what has been called minilateralism, meaning the smallest number of countries that are necessary or that are enough to solve the problem. So maybe some numbers and data are already in the OECD paper, but of course further research is needed. But I figure that 85% of the multinationals are based in a limited number of countries, so that if this limited number of countries, as it is happening right now, is undertaking the responsibility of in any event taxing their own multinationals, then you have a minilateralism. So this was just setting the scene, and I repeat this key word: defensive coalition, unilateral dominant strategies, an international regime, and minilateralism. And I think that all these features are in a way present in the current scenario. So let's now shift this very seminal, very important, very timely paper published by the OECD and authored by Anna Sinta and other prominent authors. This is the first attempt, the first serious attempt of quantifying the of Pillar 2. And of course, I mean, one critical point I want to make from the very beginning is that, of course, we understand that we needed to have the Pillar 2 in place to model its impact, so that you know, we have Pillar 2 and we already have the directive, and we are now running a very serious discussion of their I had positive impact. It should have been done before, probably, you know, a thorough study of the potential impact of a model to check whether this model was. Having said that, I was among the first to be convinced about the findings that the paper is now enunciating and putting on the table. So I just summarized these 4 findings just for the participant. First, Pillar 2 reduces low taxed profits. It appeared obvious and is now supported by data. If you subject under the Chen capital export neutrality approach the profits of a multinational in the country, then or in the country of the ultimate parent entity, then of course any kind of low profits that are taxed at a lower rate become taxed at least the minimum rate. The second findings is that the Pillar 2 reduces profit shifting. That's also kind of and obvious if you know, tax rate differentials are neutralized, then there is no incentive to shift profits to a lower rate. So that's this is very is a second very important finding. Third, and is also the first 2, there is a reduction of tax arbitrage, meaning the attempt by certain jurisdiction to in the race to the bottom to continue lowering the rates or keeping lower rates to attract profits. And that's another very important findings. And last but not least, and you know, most economists were very curious to understand what are the effects of the Pillar 2 on corporate tax revenues. And the finding that we read in the paper is that these revenues are increased, which is again a consequence of the first 3. So this is very, very comforting empirical evidence, and this is you know, basically starting point, I believe, of the presentation by Anna. I kindly ask Anna, maybe for everybody and particularly for the non-economists, to briefly explain how they were able to infer those conclusions for the available data, which is, I think, a methodological aspect which is of great importance. And finally, I close by saying a few words. My time is almost finished. So I close by saying a few words by discussing in what sense this seminal paper by the OECD is advancing a geopolitical strategic approach. And here I have a few critical comments. If I don't want, you know, to take time to share on the screen the diagrams that you can find in the paper, but essentially at page 16 of paper, there is a very clear diagram in which depicts what it is claimed to be the so-called rule order of the global minimum tax. And it starts with the assumption that most countries will adopt a Q qualified minimum domestic top-up tax, so that clearly the assumption is the first is the QDMTT. Then second, the income inclusion rule, either by the ultimate parent entity, by some intermediate parent entity, and the third situation is the UTPR, which is really the residual backup solution should no income inclusion rule be applied. Well, I think that in fact that we are now in a situation of a coalition of countries that have announced and that enforce a dominant strategy unilateral, in which they unilaterally tax global profits. Instead of starting from the qualified domestic minimum tax, we should start from the signal, the announcement, and the reality that no matter what, under Pillar 2, profits will be subject or are already subject to a minimum 15% global minimum tax, so that should there be a minimum tax, then there will be no need. I mean, the country that implements the global minimum tax basically will recognize the foreign qualified domestic minimum taxes as a credit, basically, under the top-down approach, top-down mechanism, or in other words, that country will not enforce the income inclusion rules. So I think that instead of starting from the that boils down to, and I conclude here, I think that what we see now is the enactment of a capital export neutrality based global taxation of profits in reality, and not a race to qualify domestic minimum taxes. If there will be a race on domestic minimum taxes, this will mean that the dominant strategy has worked. And this is my last statement, is a little bit provocative. Of course, the global minimum tax is a corporate income tax. But if it is true that it will elicit qualified domestic minimum taxes where rates are lower than 15%, then this means that at the end of the day, this tax is a regulatory tax, meaning that the changing behavior, and as you know, regulatory taxes are very good if they are not applied, because they achieve their result. So hopefully, if the findings of the paper are correct, and if in the next few years this prediction will be will be true, then we can say that to a certain extent we will have witnessed a paradigm shift in corporate taxation. Okay, and that's it. And I am within time, and so I go to our invited speaker, Ana Cinta Gonzalez Cabral, who will present this very, very, very important, very dense paper that I think has advanced the discussion on the global minimum tax very much. Thank you very much for your attention.
Thank you, Carlo, and thank you for that very interesting introduction, and for having me here at this seminar to be able to share some of the work that we've done at the OECD. So I will just say a few words. I'm part of the team that has been, and I'll explain the context of this work a bit more, but we're at the core of the team that carries out the economic impact assessment of the two-pillar solution. So we are economists by training. So that's first disclosure to say. So hence we wanted to put together to actually show you some of the charts behind the paper that Carlo was referring to illustrate some of these points. And I'll be very brief in some of this because Carlo has already made a very comprehensive introduction, but I just wanted to make sure that we're all on the same page when we talk about the global minimum tax. So the global minimum tax, what it does is it introduces a minimum effective tax rate of 15% for large multinationals. So those large multinationals are those with revenues above, consolidated revenues above 750 million. And the minimum tax operates in a jurisdiction by jurisdiction basis. So it means that the M&Es would be subject to the same rate under a common base in every jurisdiction where they operate. So how do we arrive to that common base? The starting point is financial accounts, and there are several adjustments that are made to that financial accounts to get you closer to a taxable income base. So that what that gives us is a common base across all jurisdictions and a common rate. One feature of the rules, as Carlo has alluded to, is how it is collected. So now we have a minimum effective tax rate. So who gets the right to collect the revenues? And there is a set of interlocking rules that basically ensure the integrity of the rules. So the idea is that the first jurisdiction that would have the right to collect the top-up tax on that low tax profits would be the jurisdiction where low tax profit arise. So that would be through the mechanism of a qualified domestic minimum top-up tax. And if after you apply a qualified domestic minimum top-up tax in the source jurisdiction, so in the jurisdiction where that low tax profit arises, if there is still some low tax profit left, so that hasn't been collected by a KDMTT, for instance, then it would be the ultimate parent entity jurisdiction that would have the right to claim that top-up tax. And if it doesn't happen, then it goes to the UTPR to all of the jurisdictions. So the UTPR is really a backstop to ensure that the global minimum tax is working. So the global minimum tax is already a reality. So as I said, it's been agreed by around 135 members of the inclusive framework at the OECD. It's a common approach, which means that not all countries that are members of the inclusive framework need to implement the global minimum tax. But we already see that some jurisdictions are already moving to implement. So we already realize that it's no longer about rules that are drafted and that were published, but and drafted jointly by members of the inclusive framework, but now jurisdictions are taking steps to implement. So by our count, there are 36 jurisdictions that are already implementing in 2024, and we count around 59 jurisdictions that have either announced implementation at a later stage or publicly announced implementation. So by 2025, we estimate around 90% of global M&Es would be in scope of the global minimum tax. And I'll just mention one more thing about the global minimum tax. So I mentioned there's a common base, the rate's at 15%. And one particular interesting feature that we're going to discuss later on is that the global minimum tax accounts on this base for the economic presence of the M&E in a jurisdiction. So that's what is referred to as the substance-based income exclusion, which basically means that the more activity that a multinational enterprise has in the jurisdiction, the less profit that would be subject or in scope of that. So we're going to see what influence that has on, and we can discuss later on patterns of investment and on top-up taxes. So that's just to set the scene of what the global minimum tax does. And I wanted to say a few words about the work that we've done in my team. So to get together with other colleagues on the economic impact assessment. So we started doing this work really a long time ago. The first economic impact assessment, when we actually looked at what the impact of the global minimum tax would be on revenues, on profit shifting, on investment, was as early as 2020. So that's where we first published our first economic impact assessment. Back then, this was very early days, so it was only based on the blueprints. So still many details of the global minimum tax were unknown. And the goal of the OECD with this economic impact assessment is really to inform members of the inclusive framework. So this economic impact assessment, even though you've only seen 2020 and now 2024, this we have been continuously updating throughout the years to actually provide evidence to members. Updates now, we've kind of summarized them into 2 working papers that we've launched at the end of the year and at the beginning of this year. So one as a Christmas gift, we released a paper on how are M&A profit taxed, and I'll show you some evidence on that. And at the beginning of this year, we released the paper that Carlo was mentioning about what the effects of the global minimum tax do. So because of the goal really of our analysis to really have this global scope, the word that underpins the statistics that I'm going to show you has a very expansive coverage. So it covers around 222 jurisdictions. Typically, when we are talking to economists or in the context of Ministry of Finance, there is a very strong focus when we talk about the global minimum tax about the revenue gains and about the fact of how much does it collect. But in this work, we wanted to take a step back because the global minimum tax does much more than raise corporate income tax revenues. So we also look at other dimensions, as Carlo mentioned. We look at its impacts on how it changes the taxation of multinational enterprises and try to give a flavor of how this can change the dynamics of taxing multinationals forward. So we look at what it does to tax rate differentials. We look at what effects that's going to have on tax competition, on profit shifting, and also we look at what it means in terms of this reduction in low tax profit or this increasing in the average tax rates that multinationals pay. So just very briefly, because Carlo has summarized more or less the results, but I wanted to give you a few numbers so that you have them in your head. So we estimate that the global minimum tax will reduce tax rate differentials between investment hubs and other jurisdictions by around 50%. This narrowing of tax rate differentials would mean that would basically have important effects, not only for shifting profits, which is the incentives to shift profits, which is the next bullet point, but also in terms of reducing the distortion from the corporate income tax system. So you can think that capital, it can improve actually capital allocation so that investment may respond to factors other than tax, which are nevertheless still very important for investors, such as infrastructure, human capital, etc. This reduction in tax rate differentials, we estimate, will have a bearing on the amount of shifted profits. So we estimate global shifted profits to fall by around 50%, but not a complete wipe off of shifted profit shifting. And at the same time, both these effects, this increase in the taxation of those profits that are taxed below 15%, and this reduction in profit shifting that would simply move some profits from low tax jurisdictions to other jurisdictions, would mean that there is an effect on a reduction of the total amount of profits of M&Es that are taxed below 15%. And we estimate this reduction would be of about 80%. So in the long term, we would have 80% less profit shift tax at the rates below 15% than we have nowadays. And all of these, we estimate that mechanically we have like a reduction in low tax profit. That means there is an increase in the average taxation of those profits. So hence there would be a revenue gain of between 6 to 8% of global CIT revenues. And that's accounting for what we call these direct revenue gains from increase in top-up taxes on low tax profit, but also 1/3 of that would come from this effect of reduced profit shifting. So that's just to give you more or less an overview of the results that we have. And just very briefly, I will summarize in 6 key steps what we are doing in this work. So we start from, as I said, like we have this 232 jurisdiction angle in our head. So the first thing that we do is we need data. So what do we try to do? We try to build matrices that can show us information on the profit and the economic activities of multinational enterprises. And we do that on a jurisdiction pair basis, meaning that we need to know for each ultimate parent entity jurisdiction, we know where those M&Es would operate. And this is based on our primary source of data is country by country reporting. So we see aggregated data at the jurisdictional level, and we build those matrices for profits, for tangible assets, for employees, etc., with our scope being around 2017 to 2020. That's our period of study. Of course, country by country reporting takes us a long way, but we still need some other macro and micro data sources to kind of complete the picture. So once we know where M&Es operate and what their activities are, then the second thing that we do is we take into account that multinational enterprises would pay very different effective tax rates across jurisdictions. So we use new evidence that I'm gonna show you in a second what it means about how M&E profits are taxed. And third, once we have this, we know what ETRs M&Es are subject to, then we apply the global minimum tax, which means that we take into account the base of the global minimum tax, we take into account this rule describing, we take into account some of the exclusions that are made to basically just narrow down to the base of the global minimum tax. And then we take into account two behavioral responses. The first is the behavioral response of multinational enterprises, that they respond by reducing shifted profit. Again, we're going to see there's a lot of uncertainty about how multinational enterprises react. And then the second behavioral response is what do governments do? And then what we take assumptions, we're going to make assumptions about the implementation, the level of implementation of the global minimum tax. And with all that picture, with all those 5 steps, then we then assess the impact, as I said, on those 4 key dimensions. And I also find it interesting to say, or useful to say, to comprehend basically what we're not doing. So we don't have firm level data, so we cannot see M&E level information. We don't take into account we take into account some adjustments to match the base of the global minimum tax, but of course, there are many of them and our data is limited. And our analysis, what it does is a long-term perspective. So we take a long-term view of what effects the global minimum tax would have in all of these factors. So we don't try to seek life tracking implementation, or we don't try not to go beyond other responses than those that I have just mentioned before. So the reduction of profit shifting by M&Es and implementation by government. So things like what would happen to investment impacts, what would happen to firms actually introducing other types of incentives or removing certain types of incentives. We don't actually look at those type of responses. So I just wanted to be very clear to frame the results. Okay, so first, so we're now moving on to more the results part. So the first point when we started to do this work is actually we realized we don't have great knowledge about how M&E profits are taxed. So when we started looking at our EIA 2020 paper, but at our economic impact assessment back in 2020, but also how most of the literature has actually looked at low tax profits, the approach was very dyadic. So you would look at in your left-hand side, so that's basically a distribution of effective tax rates in a high tax and low tax jurisdictions. So we would say if you're a panel A, so you're in a jurisdiction that is high tax on average, then all of your profit is high tax and you have no low tax profit. And if we look at a panel B and you're a low tax jurisdiction and we look at your average ETR of M&Es in your jurisdiction and that would be below 15%, then we would say, well, this jurisdiction, all profit is low taxed. Now that's a very simple, it's informative, but it's a very rough approach because of course you can think of reasons why you would have M&Es paying low taxes in high tax jurisdictions, and also if you're an average low tax jurisdiction, it doesn't mean that all your profit is low taxed. So the first thing that we tried to do was to say, okay, let's move from this very rough approach to something a bit more refined, where we can actually estimate how much of the profit in a high tax jurisdiction is subject to low tax rate, for instance, because you have a tax incentive, and at the same time clean a little bit the estimates of profits in low tax jurisdictions. So I'll spare you the details, and I can talk about this later on if there is interest. But the idea is that we exploit some new data that comes from country by country reporting data that tells us what's the percentile of the distribution of effective tax rates that firms pay in each jurisdiction, and we use that to map how would profit be taxed. So what is the outcome of this? So the outcome of this is that it's summarized in this chart. So if you look at panel B for a second and you focus on the second bar where it says low taxed, that bar shows you the percentage of, so it shows you 100% is the full amount of low tax profit that exists. And it's divided by different average effective tax rates. So what we see is actually that there is a substantive amount of profits that are low tax that are in jurisdictions that are on average high tax. So if you look at the 15 to 25 bar or the above 25 bar, you would see that around more than half or a bit more than half, 50% of those profits that are taxed below 15% are actually in jurisdictions that are high tax. So that means that the methodology that we're using is actually uncovering a whole pile of low tax profit that otherwise we would be missing out. And if you look at the first panel, it shows you exactly the same picture. And the idea is that whenever we talk about low tax profit, everybody thinks investment hubs. Low tax profit are in investment hubs. But when you actually look at the second bar, you're going to see that around 60% of those low tax profits taxed below 15% are actually outside of investment hubs. So that's an interesting finding because that's going to help us understand where are the revenue gains sitting from the global minimum tax. And the idea is that it's very much spread across different types of countries. So just very briefly, I'll say two more things about the methodology, and I won't get you anyway, and I'll move quickly through them. So the first is that we look at approximating the global minimum tax base. So we take into account exclusions, we take into account some of the adjustments that are done to the global BTR to account for the way that the rules treat certain temporary differences. We take into account as much as we can exclusions. So for instance, we take into account the fund exclusion. We take into account how the globe will say that they would interact with control foreign corporation regimes. In this case, we model US guilty. And we also adjust global income to account for this substance-based income exclusion. So all of these adjustments, I don't want to get into a lot of detail, but I can speak to them. The idea is that this is something that was new from what we did beforehand and was signaled as very important because actually it was getting our estimates closer to what the global minimum tax would do. So all of these adjustments actually means that we actually get lower revenue estimates than we got before, but actually a bit more accurately matching what the global minimum tax does. And this is the second slide, and that's the last note that I would say. It's that when we look at profit shifting, we know that profit shifting reactions of MNEs are very uncertain. So we take different scenarios. We look at different scenarios of how the base would react to different tax rate differentials. And different ways of computing that tax rate differentials to actually build some uncertainty around our estimate. And the second thing that we do is we look at what's the full extent of implementation that we assume. And as I said, this is a long-term perspective, right? So we don't try to look to assume any life tracking. So we take into account two scenarios. So one, where all countries in the world implement a qualified domestic minimum top-up tax and IIR and UTPR, and a partial implementation scenario. And here what we assume is that if you're a member of the inclusive framework, then you would implement with different probabilities, so 70, 85, or 100%, except if you don't have a CIT infrastructure and a zero tax jurisdiction. And if you're a non-IF member, then you wouldn't implement the global minimum tax. So that gives us a bit of variation. So with this in mind, I'll now pass on to the results. So I have one slide that speaks to each of the results that I mentioned before. So what this slide shows you is the differentials between all jurisdictions and investment hubs before and after the global minimum tax. So if you look at before the global minimum tax, you would be looking at that gray, almost like a bit flatter distribution. So that means that tax rate differentials could be quite high. In effect, you would have jurisdictions that have salary tax rate or effective tax rates that near the 30s, and you would have the lowest ones would be at zero. So then those tax rate differentials could be very flat. And what the global minimum tax does is by increasing the taxation of those very low tax rate, what it does is that it squishes effective tax rate differentials. So some of them would actually disappear. That's why you would see a bit of mass at zero. So some of those differentials between jurisdictions would close, and otherwise they would become narrower. So we estimate that if you look at only differentials between other countries and hubs, you would see that those differentials would fall about 50%. So we think this is important because not only because it would decrease also profit shifting incentives, but because it would actually also might reduce the distortions coming from the tax system. So improving that allocation of capital and potentially increasing those non-tax factors, education, infrastructure, human capital, that are even more important for capital allocation. And as I foreshadowed, whenever we have this reduction in tax rate differentials, the literature tells us that profit shifting actually reacts to these tax rate differentials. So once we take this evidence that actually these tax rate differentials actually narrow, and we put it into our model, what we get is that profit shifting would actually, we estimate, would fall by around 50%. So what does this mean? What does this chart shows you? It shows you the change in the tax base. So where are shifted profits in our model? They're basically sitting on investment hubs. So investment hubs, we estimate, would have a reduction in tax base of around 30%, which would mean that those profits would flow out of investment hubs and into all other jurisdictions. That's why you see all other jurisdictions would actually gain tax base. And of course, whenever we look at these profit shifting effects, we know that those would not unravel immediately, right? So these are not effects that one would expect to happen tomorrow. So again, keep in mind, this is more a long-term effect. So M&A, like profit shifting structures, may be sticky. So there might be lots of reasons why firms might take time to adapt. And if you put together the two direct and indirect effects of the global minimum tax, so this effect of profit shifting, increasing, reducing profits in investment hubs and reallocating them to jurisdictions where they're going to be higher taxed, with the global minimum tax that would bump up everything that's taxed below 15%, what you get is that low tax profits are actually significantly reduced. What this chart shows you is the percentage of total profits that are low taxed in a world where there is no global minimum tax, that's the gray bar, and then in a world where there is a global minimum tax, and that's the blue bars. And the difference between the blue bars, it just takes into account that there is a transitional period for the substance-based income exclusion. But if you ignore that for now, then you can just compare the first gray bar to the last blue bar. And as I said, like if you look at the global figures, you would get a reduction of around 80% of low tax profit. And when you look at where it comes from, you would see it's very high in investment hubs. So it's going to be very acute, this reduction in global low tax profit in investment hubs, because naturally they have a lot of low tax profit. But because of what I said before, that we actually now we have a more refined look at how much low tax profit there is in other jurisdictions that are not investment hubs, we actually see low tax profits declining in other jurisdiction groups. So that's also important to keep an idea of the distributional aspects of the global minimum tax. And lastly, and almost mechanically, whenever we have this average increase in the taxation of multinational enterprises, then you would have a revenue gain. And that we estimate to be, as I said, between 6 and 8% of corporate income taxes, and 2/3 coming from direct taxation, 1/3 coming from indirect taxation. So from these revenue gains from profit shifting. So what you see in this chart is a divide between the two scenarios that I was talking about. So if you go to the left-hand side, that's the global implementation scenario. There, what we see is that all of the revenues would be collected by the qualified domestic minimum top-up tax. There is no other operation of the rules because the QDMTT would be the primary rule that basically collects all top-up taxes coming from the global minimum tax. In the partial implementation scenario, then what we see actually is the role or how the mechanics of the rules operate. So then we're going to see that blue part that we see in global implementation split between the three different rules. So we would have one part that's the qualified domestic minimum top-up tax, but now you see also the income inclusion rule entering into place to capture some of those low tax profit that the QDMTT are not capturing. And again, the UTPR, where the IIR is not capturing those low tax profits. So what this chart is basically just trying to illustrate that depending on how the implementation of the global minimum tax varies, then we would see basically a different split between qualified domestic minimum top-up taxes, or how much top-up taxes collected at source versus how much top-up taxes collected by other jurisdictions. And the gray bit on top that you see is those revenue gains that we ascribe to this profit shifting reduction, again, with this long-term perspective. So I'll stop here just saying that the global minimum tax will basically change very significantly the way that multinationals are taxed in this new environment. And sometimes we focus too much on revenues and we kind of lose sight of the impacts of the reform for how it basically shapes the way that multinationals or the environment for the international corporate taxes. So we forget these effects on tax rate differentials or these effects on the reduction of profit shifting, and what that can mean for how we do tax policy going forward. So one of the key opportunities that the global minimum tax is actually bringing is, again, having being able to basically revisit the principles in which we are using the tax system, for instance, for things like promoting investment. So we wrote, for instance, in 2022, a report that actually tries to reflect on what the global minimum tax, for instance, means for the use of tax incentives. But again, it can open, it basically gives a different perspective or an important perspective for policymakers going forward. So I'll stop here. And I'm happy to take any questions after William's intervention. Thank you.
Okay, so I guess it's my turn. So I'll do three things. I'll talk a little bit about the US role before Pillar 2, specifically the adoption of the GILTI and BEAT in 2017, which I think to some extent were the inspiration for Pillar 2 happening. Then I'll talk a little bit about the interaction between the US rules and Pillar 2 as it was developed. And finally, I'll say a couple of words about what I see as some of the problem areas that remain to be worked at. So first, I think follow the development of BEPS as a whole, it's pretty clear to me at least that the first stage of BEPS between 2013 and 2015 fell far short of the expectations that people had of it in the beginning because of essentially, to a large extent, opposition of the US to Action 1, for example, which was the digital economy, the minimal adjustment to transfer pricing rules and so on. I mean, you can debate about that, but I think the second stage of BEPS, namely in particular Pillar 2, has been a very significant achievement. And I think to a large extent, this was, as Carlo would say, strategically the result of unilateral US, because what happened in 2017 is that the US had a significant tax reform highlighting a pretty dramatic reduction of the corporate tax rate from 35 to 21, plus also a reduction in the individual rate for pass-through businesses from 37 to 29. And so all that had to be paid for to a significant extent. And the obvious way of paying for it was the fact that US multinationals before 2017 had $3 trillion sitting in investment hubs, basically. And that was not taxed by anybody. And so this was a very big pot of money for politicians to take a look at. And they did two things. They applied this retroactive tax that is now before the US Supreme Court because people are claiming it's unconstitutional, but it collected retroactively a bunch between 8 and 15% tax on the $3 trillion. And secondly, they implemented these two steps, GILTI and BEAT, the GILTI standing for tangible low tax income at 10.5%, and BEAT is an alternative minimum tax on outbound payments to related foreign parties, and those are kind of the inspiration for the IIR and the UTPR, respectively. There are differences, of course, because probably the most obvious one is the rate is lower significantly, which is one reason that the GILTI is not a qualifying IIR. And secondly, it's calculated on a global basis, so it's not country by country like the Pillar 2 IR is supposed to be. So because of that, the US in 2022, the agreement was reached in October 2021 in principle, and then in 2022, the Biden administration introduced legislation in Congress to implement Pillar 2 comprehensively, but that failed. It failed by one vote in the Senate, but it still failed. As the result is that we don't have Pillar 2 in effect at the moment, and it's not clear whether we will have it in the future, although I should say there next year, because a lot of the 2017 law expires in 2025 after the election, they will have to take another look at it because these expirations are very unpopular, many of them, and as a result, it's almost certain that there will be tax legislation in the US next year, and everything will be on the table to a significant extent. And of course, it depends crucially who controls Congress, who controls the White House, and so on and so forth. Who knows? So the current state of affairs is GILTI does not comply as a qualifying IIR. However, under the deal that was reached in October 2021, it does count as a qualifying CFC rules, and CFC rules come before the QDMTT. So in terms of the hierarchy, the US is able to collect GILTI with foreign tax credits, admittedly, but it's able to collect GILTI as needed. And I should also note that the GILTI rate, again, is supposed to go up automatically next year to 16% from 10.5%. And if that happens, of course, it's above the 15% effective tax rate for the global minimum tax. Let's see whether that actually happens. That's one of the things on the table. Now, there was, however, another important development in 2022 that I should highlight, and that is the adoption of the corporate alternative minimum tax by the US. And that is a very interesting phenomenon because unlike GILTI, for example, it genuinely globally. That is, it takes the entire multinational as a single unit, which has never happened before. GILTI builds on the old separate F, which builds on, it only applies basically to the foreign multinationals, and it has a lower rate. The CAMT, the corporate alternative minimum tax, applies globally, and it has the same rate, and the rate is 15% based on book income. It comes pretty close, I think, to being something like a combination of the QDMTT for domestic income and an IIR for foreign income. And of course, again, foreign tax credits are applicable. Again, it's not country by country, it's global. But nevertheless, I think that this, in my mind, means that it is less likely to some extent that American multinationals will actually pay tax at less than 15%, although it remains to be seen. But this is the law now, and I think it's an important development. And it certainly, again, going back to Carlos' remarks, implements capital export neutrality in a way that, this is basically what the Kennedy administration proposed in 1961, except that we had it before. And now we have it at least at, but again, the rate, of course, is only 15 as opposed to 21, which is the domestic rate. But 15 is the agreed upon rate internationally now, so that's fine. I should also say one thing about the country by country business. So, and this is a somewhat technical point, but it's important to appreciate. So, what is the problem with not apply? The reason that it has to be done country by country is that when the foreign tax rate in some countries is higher than the domestic rate, so in a country that has a higher rate than 21, for example, from a US perspective, that creates an incentive because of the foreign tax limitation to average the foreign income and therefore invest in low tax jurisdictions, because that way you can reduce the overall average foreign tax rate to precisely where you want it to be, which is the same as the American rate, or in this case, the same as the GILTI rate. However, that assumes that there will be a lot of foreign countries that US multinationals operate in that have a higher rate than the American rate. And I think the effect of Pillar 2 is likely to be that gradually a lot of countries will drift towards 15 because that's what they want, and that complies. And a lot of multinationals will shift activity towards countries that qualify for the 15. And if that's the case, then you will not anymore have excess credits because the foreign rates will not be above the American rates, they will be below. And when the foreign average rate is below the American rate, then country by country doesn't matter anymore. There's no incentive to shift. So that's why I think that this important differential between the way the US does it and the way the OECD does it is not as important perhaps as it has been made to sound. Okay, so that's in terms of the current situation. Now let's talk a little bit about some of the problem areas. From a US perspective, the biggest problem area is the UTPR and its potential implications, because the US has been giving massive tax incentives for domestic investments. This already started in 2017 because since GILTI has a lower rate, half of the domestic rate, there was concern that there would still be a significant shift in incentive because GILTI is 10.5 and domestically is 21. So as a result, we created this parallel regime, the FDII, the Foreign Derived Intangible Income regime, which gives you the same rate as GILTI, but for domestic that are oriented toward exports. That's actually a blatant export subsidy in violation of the WTO rules, but the United States doesn't care because we've been sabotaging the WTO for a long time now by not appointing members to the appellate bodies, so we can't be sued as a practical matter by the EU, for example. And so this has been pretty effective. There's data now that shows that tech companies, the digital giants, have been shifting export-oriented IP pretty massively back to the United States from various offshore locations because they get essentially the same rate under GILTI and under the FDII rules. That's not true for other American pharmaceuticals, for example, have not been doing that. And the reason is because they actually have physical facilities abroad, and physical facilities qualify also under the SBIE. But our parallel to that is the rule that the first 10% return on physical facilities is exempt completely when it's repatriated to the United States. And so pharmaceuticals have been shifting much less, but there still has been significant shifting, especially by the tech companies that rely primarily on intellectual property. So that's the old rule. And the rate is 13.125, so it's below 15. And then now, as of 2 years ago, we have these massive subsidies to, for example, manufacturing, domestic chip manufacturing, to various green credits and so on and so forth. And the concern is that all of these will bring the domestic rate below 15. And part of the reason is that those subsidies were explicitly made an exception to the corporate alternative minimum tax, so it doesn't apply, even because you don't want to reduce the and that's the big concern in the United States now, because there's a strong feeling in Congress that there's something not okay about foreign jurisdictions collecting tax on local subsidiaries of American multinationals in order to essentially eliminate the effectiveness of US domestic tax incentives that both tend to believe in, and the CHIPS Act in particular was passed with a large bipartisan majority. And so that's why, at the moment, as you may know, the UTPR is on hold as far as the United States is concerned, or to be more accurate, there's a safe harbor that says that if the country has a nominal rate of above 20, the US has 21, apply at the moment. And I have some doubts about it, whether it will ever apply. One reason that I say that is simply because in Pillar 1, it's pretty clear that the United States was given a veto, right? The reason that the multilateral agreement under Pillar 1 will not come into effect, I believe, this year, or maybe ever, is because officially the United States is very unlikely to ratify the multilateral convention. So I suspect that as a practical matter, the United States has a veto about the UTPR also. And if that's true, then I wonder about some of the estimates in the paper, because the United States is a big economy. And so I think that should probably be taken into the possibility that the UTPR simply will not apply to the United States, and therefore some of the US profits will continue to be taxed at significantly below 15%. And another thing that goes into that, which has not really been mentioned, is the whole business about qualified refundable credit and non-qualified refundable credits, and in its interaction with the SBIE. I won't go to that, but basically most US credits are not refundable, but some of these credits that were enacted in 2022 are refundable. That is, you can get them in cash, or you can sell them, which also qualifies, and that goes into the ETR calculation as well. Finally, I should raise one kind of final point, which is I think part of the problem with the way the Pillar 2 works is that there's no good definition of what income is subject to the QDMTT, and the QDMTT comes first. In order to define that, you need to rely on two things. You need to rely on the rules of the jurisdiction that applies the QDMTT, because that's how it works, right? And you have to rely on transfer pricing, which basically is supposed to define what income is subject to the QDMTT. And I don't think either of these things work very well. And my concern is that when you have kind of the classic situation where the IP is developed in country A, the is in country B, which traditionally was an investment hub, or a country that gave you a low tax rate, and the sales are in country C, even with the global minimum tax in place, the country where the IP is developed and the country where the stuff is sold will have problems with the scope of what is subject to the QDMTT, and that can lead to double taxation if the and transfer pricing is not very helpful in this regard. Because of that, my view is that it would have been very nice to have Pillar 1 as well, because that solves the problem, because it allocates. But you don't have Pillar 1, and you're not likely to have Pillar 1. So I think Pillar 2, in the absence of Pillar 1, or in the absence of some allocation rule, is going to be problematic. And that's basically, I think, the way this will be in the future. So that's what I have to say, because I want to leave some time for Q&A, and so I will stop here.
Okay, thank you all for this very interesting presentation. I open the floor to the discussion, so whoever wants to raise the digital hand is more than welcome, and or write a comment in the chat. I take the opportunity just you to make clarification. So when like in 5 years from now, what do you think would be the implementation of the global minimum tax? I mean, how different? I mean, Anna mentioned a quite impressive figure when she said that investment hub might lose 30% of their income of their tax revenues, if I understood correctly. So I was wondering how different the world you imagine would be in 5 years from now, if and I mean, if this path is followed, then what are the alternatives? And then Carlo is obviously welcome to make his comments.
Yes, I actually raised my hands to ask a question to everybody, not to reply to your very, very interesting and difficult question, because as you know, nowadays, to make a prediction for tomorrow is almost impossible. So over a 5-year period is very difficult. Frankly speaking, I am a famous pessimist, but in this case, I'm optimist, and I think that in light of the fact that the global minimum tax rate is a compromise, and in my view is very low for taxing global capital, I think that in 5 years we will find an equilibrium at the 15% rate, and somehow everybody will be happy. Of course, discounting other unpredictable major geopolitical or political or ecological events. So that's my guess. No, my question for everybody, and then of course Anna and Ruben might want to answer your very good question, is, but frankly speaking, you guys, do you understand technically what is disqualified domestic minimum tax? Because I don't. Because I understand what is the global minimum tax, meaning the income subject to the income inclusion rule, and the very complex procedures of the model rules. And in order to know that, you have to go through all the details of the procedure to come up to the conclusion that you are below or above the 15% minimum rate in a given jurisdiction. But then to be qualified, you have to run all the machinery of the Pillar 2, but it doesn't seem that it works that way. So how you qualify as a domestic minimum tax? You know, that's the question that I have for everybody, because I don't understand, frankly speaking. Maybe from the OECD there is an institutional answer, or maybe Ruben as a guess. And that's all I have to say.
Okay, let's go for the first round of question, and we look if is anybody. Carlo Altomonte. Carlo, it's the floor is yours. Maybe we should. No, I think you can speak. Yeah.
Thank you all for this very interesting seminar. I've written down actually 2 questions Q&A session, but I can just report them. One is on a more technical note to Anna, that is about the fact that you're using this country level data, while we now have available very detailed firm level data on the activity of multinational enterprises all over the globe. One is foreign affiliates trade statistics, which are being used by OECD. They are notoriously complicated to an extent in terms of data quality. But the other one is this Orbis, so Bureau van Dijk Orbis ownership database that I know the OECD is also using, and I've been using for research purposes. And there you can easily map the ownership network of more than, I have mapped 6 million headquarters and affiliates in the world with linked balance sheet data. So I was wondering to what extent you're planning to at least maybe validate some of the findings that you get with country-specific data, which I understood have a number of characteristics that allows you to control for a number of, let's say, robustness checks in your data. But maybe for some countries for which firm level data are particularly good, or regions, maybe it would be worth seeing whether you can learn a bit more color with the use of firm level data on some of your assumptions and robustness checks. So that's the first technical question. And the second one is very simple but very sensitive politically, and that is whether you have a sense of, given your estimates, 150, 120, 190 billion euros, how much of these extra revenues would accrue to an entity like the EU27, the single market, for example. Just to give an idea, roughly speaking, whether it's a third of all this, a fourth, 50%, something like that. Okay, thank you.
Okay, let's go with the first round of answers, and then we see if any other question rises.
Maybe I can go first, if that's all right. So I start with maybe your question, Stefano, which is very interesting and also very, very hard, right? Like as Carlos said, like it's hard to anticipate what a world would look like 5 years from now. But I think it's difficult because there are many behavioral responses that are involved. So this is the behavioral response of multinationals in terms of how do they react. There are very important questions about what would their investment responses be or not be. At the same time, there are important responses in terms of the governments, right? And one of them that we focus on is implementation of the 15 tax rate, but there are many more, right? Like countries are looking at their tax incentives, they are looking at how they're going to reform. Now that you have a minimum tax that's going to be applicable at different jurisdictions, some academics have also raised that it could also lead to not a convergence to 15%, but actually some countries actually raising the rates, because then now you have a 15% tax rate, then it might also be that you can actually go a bit higher because nothing prevents, the new floor is at 15. So then, that can also pretty much change the dynamic. So I see there's always like there's a very kind of straight tendency to think, well, 15 might be the lucky number, but I think it's also important to take a broader look at the type of reforms that are happening, and some countries might be actually also overcorrecting. So I think those elements of the way in which the global minimum tax can actually impose this minimum level of taxation everywhere, it's important also to take into account in analyzing those responses, those effects on tax competition and incentives to, as I said, like a bit at the end of my exposition, right? Like rethink what would the tax system look like now that we have a global minimum tax, rather than thinking about the angle with our kind of all hats of there is no global minimum tax and still like we're trying to use the tax system in the same manner. And then I'll maybe just clarify on the qualified domestic minimum top-up tax. I mean, there are rules that actually explain how you can calculate the QDMTT. The idea being that the QDMTT would just be mapping, so it should actually map what the globe rules do in a sense. So it has a similar principle, and this is like an economist talking, right? Like I'm not a lawyer. It's full disclosure, not part of the team that actually is drafting those rules. But there is like very clear guidance on how the qualified domestic minimum top-up tax should look like. And for instance, like I'll give you a sense, like the rules, what the rules would tell you is that, well, it has to look like mimic what the globe rules do in terms of the calculation, but it can be even a bit stronger in the sense that you, for instance, you don't need to consider a substance-based income exclusion. So those are kind of clearly laid out in the kind of administrative guidance that develops that idea. And I think it's an important mechanism because it does change the rule order, right? Like I think if you look at the globe rules by itself, then you have a tendency to say, well, it's actually residence countries that are collecting that top-up tax, but QDMTTs actually revert that order and give the source jurisdiction the first right to tax that income. And that's why I think it's kind of an important element to bear in mind. And lastly, maybe I take Carlos' questions on more on the technical side, and thank you, Carlo, for those. They're super interesting. And we did do a lot of thinking when we started doing this and what data to collect or to use. And the reason why we're not using all those sources as a primary source is because of coverage. So we use them, all of them. So we use country by country reporting, we use foreign statistics, and we use Orbis, the three data sources, in order to compute these matrices of where multinationals operate, because it's so granular in terms of how many jurisdictions, how many affiliates they operate, that otherwise, unless we combine the three, there's no possible way we would get a full picture. But we privilege country by country reporting data because it has the scope built into place. So it's also collected for 750. So it does directly relate to the multinationals that we care about in a way that FATS doesn't really necessarily. And with Orbis, we have very well-known issues of coverage. So it's very well covered for instance, for Europe, but then in other jurisdictions, it's not so well covered. So that's why we couldn't use it as the primary source, but we do use it to complement it. And I can see that if one was not having our kind of approach in terms of the global number, but more of a country-specific approach, it actually is an interesting exercise to try to see how the two compare. And in terms of I don't have the slide with me, but in terms of the split of the revenue gains, it's an interesting question because, again, like to which income group it accrues, what we see is actually that it really depends on your assumptions on implementation, right? Because again, of how much you assume QDMTTs are prevalent. And we do have a breakdown in the paper where we use in the 70, 85, and 100%. We actually see a split by income groups, but I don't have the figure in front of me. So we don't split regionally, but we split by income groups. So you can maybe refer to the paper and have a look at that. But again, it does change a lot with whatever you assume implementation of the global minimum tax would be.
Thank you. Thank you, Anna. Very clear.
I mean, I think just to respond a little bit to Carlos' question, the QDMTT is a late arrival, right? Originally, there was only the IR and the UTPR as parts of Pillar 2. And I think the recognition was that you need to accept the all primacy of source jurisdiction with foreign tax credits attached. And so you got the QDMTT, but it has various issues attached to it. I mean, it's already mentioned. If you have real investment, you get a credit. That's the SBIE. the more real investment you have, the more you get a credit. So the effective tax rate goes actually below 15 from that perspective. And that means that you will have an incentive to shift real investment towards QDMTT jurisdictions, assuming that the rate is 15 there and higher in other countries. And as Anasinta mentioned, some countries are interested in having a significantly higher rate. And so you'll have a shift of jobs, a shift of assets, and so on. And there's a famous example of the highly paid manager with the Porsche that qualifies on the payroll and the tangible asset. Although that's not quite right, but I think that is one issue. The other issue is the qualified refundable credit business. That if you have cash refunds, they only count as income. They don't reduce the ETR directly, so the impact is much lower. And various countries have set up these kind of funds in order to essentially compensate for the application of Pillar 2. So Vietnam, for example, says that it will use the money that it collects from the QDMTT to give cash subsidies. Now, the OECD says if they're too linked together, you can't do it. But there's still a question about the effectiveness of these rules, how they will be enforced, and also what does directly linked exactly means in this case. I mean, if you spread it over all taxpayers, for example, you lose the linkage. And then again, all of these things reduce the real effective tax rate below 15. And then there's the issue that I mentioned earlier, which is the QDMTT depends for its implementation on the arm's length standard and on things like the word attributable, that is, as in attributable to a permanent establishment. And notoriously, attributable to a permanent establishment is a very, very difficult concept to measure. That's been true for a very long time. And there's nothing that Pillar 2 really does to prevent fights about that, especially in the kind of situation that I mentioned earlier, where intellectual property is developed in one country, the stuff is sold in yet another country, but the actual manufacturing happens in the QDMTT country. I can foresee that there will be tension about who gets the income. That is, the IP country will say, like the United States tends to say, all the values in the IP. The country where the stuff is sold will say, well, marketing intangibles, some of it belongs to us. And of course, the QDMTT country will say, well, it's all manufactured here, so it all belongs to us. And there's nothing that Pillar 2 does to solve this. And because of the primacy of the QDMTT over the IIR and the UTPR, they get to decide first. So a country like Switzerland, for example, which adopted the QDMTT by referendum last year, I think will try to claim much more income than it used to when it was a really low tax tourist.
Okay.
Yeah. Can I just step in react very quickly, Stefano, to this?
Yes. Yeah, you have 5 minutes, and then we are
It's plenty
out
of
of
time because I
time.
want to give room to the others. No, just what Ruben said confirms what I said. So if you basically start with a chain-based tax mechanism, and then along the way you revert to a chain-based mechanism, basically on the qualified minimum tax, an animal that is somehow similar to the global minimum tax in a territorial jurisdiction, then you are back to the starting point. And in addition to that, it's correct what Anna said, that we have the administrative guidance of July 25th that tell us what the qualified domestic minimum tax. It's just a very interesting report that says it must look like the global minimum tax territorially, but that's not enough. Multinationals have a huge transaction and monitoring cost in administering the computation, the very, very precise computation of the global minimum tax that, of course, are required in order to prevent abuses. And then any country, Vietnam or Italy, says, well, we do have a qualified minimum tax. It looks like the global minimum tax, more or less. it seems to me, a contradiction in terms. I mean, it's like, I adopt the dominant strategy, I take the umbrella, and then I go out, it rains, and I take out the umbrella. I don't understand that, frankly speaking. So, I mean, I am, it looks like that, we will have some sort of taxation in market jurisdiction with all the problems that Ruben mentioned. And then we are, first of all, the transfer pricing, and then we are back to step one. I think that's only my reaction on the qualified domestic minimum tax.
I'm just going to say, like, just one point to that. So there's going to be there's a peer review process that is coming into place, right? Where the qualified status of the rules of each jurisdictions are going to be reviewed by the members. So it's a peer review process, right? So that peer review process, the idea of that is that you would have an agreement on what is a qualified rule and what it's not, right? And that by nature would also shelter some of that, I think, concerns that you're kind of raising in terms of, well, what about the coordination of these rules, right? So that's basically what the peer review process is trying to do, and a bit of certainty of what would basically be a qualified, right? So that's also, like, I think, another important element that they're working on at the moment. So to have these points. Another point that I wanted to mention is that MNEs are going to have to submit a global information return. That global information return, you can see that the fields of that have been agreed, so you can see how detailed it is. And they're still working now on the framework is still working on the exchange of information for that global information return. But the key idea of that is that you're going to have a very detailed description of the calculations that MNEs are doing in a very detailed way. Like, as in, you go by it, like it's really a lot of, like, information in all the adjustments that they take. And then in that global information return, then there's going to be like sufficient transparency, or there's going to be quite a lot of information jurisdictions also to investigate basically whether the rules are being applied in a way that they think they should. So that's also, like, another, maybe just like 2 points that I wanted to raise that may be giving a bit more color to the discussion that you were having.
Okay, I think that was interesting. I think it's just the beginning of a conversation that will stay with us for long. I mean, the Institute for European Policymaking is quite young think tank, so I hope that we can count on you to have this conversation ongoing. And I thank you very much, everybody, for being here. But I just leave Carlo a final comment, a final remark, just to wrap up. And then we have to close.
Which Carlo, myself or Monte?
No, yourself. So
okay. We have two Carlos here. No, yes, I totally agree with you, Stefano. It was a very interesting workshop, and it's just the beginning of a conversation. So definitely, we look forward to a continuing cooperation, and possibly in the future, maybe if the OECD is interested, we can think in terms of the work that you guys have done with the paper has been should have been descriptive, right? So what we are looking, what is the situation? It is possible that the OECD will improve its work by looking at some normative framework in terms of scaling up to strategies that predictive effect, right? So as I said at the beginning, something like running your exercise before implementing whatever kind of rules, it would be very useful in the future, and maybe scholars and other experts can make a contribution in that direction. So thank you to everybody, and have a very good day, and we will keep in touch in the future.
Thank you.
Thank you again.
Thanks to all.
Bye.
Thank you. Bye-bye.
Thanks to the participants. Ciao.
Bye.
Ciao.
Ciao.